Tax-deferred growth is one of the main perks of retirement accounts, but many aren't sure whether or not tax-deferred or tax-free is the right one for them. In this video, we're going to cover the main distinctions between the two and provide you with the information you need to make the right decision to meet your financial goals. Tax-advantaged growth can substantially increase the amount of wealth you can accumulate in a retirement plan, since the earnings or the growth of an investment is not taxed until you take a distribution of such asset under the plan. Now, whether it be you get a tax deduction up front or pay the tax on your contribution to enjoy tax-free distribution of earnings from these accounts, the tax advantage growth on these particular investments while they sit under a retirement plan can provide dramatic benefits in accumulating wealth for retirement. Now, when it comes to retirement plans where you can possibly get a tax deduction on your contributions, there are three different types of retirement plans that are available. The first one is what we call a traditional IRA. In a traditional IRA, the contributions may be deductible. A SEP plan and a simple plan are those what we call IRA-based employer-sponsored plans. In other words, employer can actually contribute on behalf of an employee in these plans and use those contributions as a tax deduction, meaning lowering their taxable income for the year. In these particular accounts, the contributions that are invested grow on a tax-deferred basis. In other words, the earnings on the investments will not be taxed until they distribute those assets from the plan. These accounts may be best if you want to lower down your taxable income for the year. However, the assets distributed from these plans will be taxed upon distribution. Now, to determine eligibility to contribute to a traditional IRA, there are no income limits. However, for an individual to contribute to a traditional IRA, they must have earned income or taxable compensation. And keep in mind again, the earnings do grow tax deferred. In other words, the earnings are not taxed until you distribute those funds from that retirement plan. The other type of IRA is what we call a Roth IRA. Unlike a traditional IRA, contributions to a Roth are not tax deductible. Therefore, those contributions have been taxed already. However, those contributions made to a Roth IRA that are invested grow on a tax-deferred basis, meaning that the earnings are not taxed while it's sitting under the Roth IRA. The main benefit of a Roth IRA, however, is that once the individual satisfies certain criteria, the distribution of the earnings may be distributed tax-free. So therefore, unlike a traditional IRA, a Roth distribution may be tax-free in the future. To contribute to a Roth, similar to a traditional IRA, an individual must have what we call earned income or taxable compensation. However, unlike a traditional IRA, there are income limits on who can contribute to a Roth IRA. So therefore, pay close attention to what those limits are. Although contributions to a Roth IRA are not deductible, one of the main benefits of a Roth IRA is that not only do the earnings grow tax-deferred, eventually the earnings will not be taxed for the lifetime of that individual, as well as that tax-free nature of distributions will be passed on to the beneficiaries. Roth IRAs are also not subject to what we call required minimum distributions. This means that upon attainment of a certain age, and that age is age 73, the Roth IRA holder does not have to take any distributions at all, unlike what we call a traditional IRA, a SEP IRA, or a simple IRA. Another big benefit of a Roth IRA is that contributions can be distributed at any time, no tax nor penalty. Given the fact that contributions have been taxed already, it shouldn't be taxed again once it's distributed, nor is it subject to a 10% early distribution penalty because those assets, again, have been taxed already. Roth distributions also do not affect other benefits an individual may be receiving upon retirement, such as Social Security. Saving under these tax advantage plans can maximize your opportunities for growth in building wealth under your retirement accounts. Now, whether or not you want to get a tax deduction and postpone the taxation on the earnings will be dependent upon you. There are other options by paying the tax on the contribution to enjoy tax-free distribution of earnings from particular accounts such as the Roth IRA. It's important to do your own research to determine which growth strategy is the right one for you. If you want to learn more about the requirements and benefits of each type of plan, read through our tax-free or tax-deferred blog post, or download our comprehensive guide, both linked in the description below.